Secrets of Sand Hill Road. Written by Scott Kupor. Summarized by goldreaders.com. Please subscribe to this YouTube channel. Introduction. In the late 15th century, Queen Isabella of Spain took a big risk by providing funds to a businessman, Christopher Columbus, for an adventurous project. This might be seen as an early form of venture capitalism. Columbus aimed to find a quicker trade route to India, aiming to save time and money. The chance of failure was extremely high, just like today's startups that are supported by venture capitalists. Although failure nowadays doesn't mean life-threatening situations, the risk remains significant, with about 90% of startups not succeeding. This is where effective venture capitalists, VCs, step in. They offer financial support to promising founders, enabling them to bring their ideas to fruition. In return, VCs gain a share in the company. Besides funding, VCs guide founders in making crucial decisions and achieving strategic objectives. The world of startups often finds the inner workings of VCs puzzling. Luckily, Scott Kupor, an expert in the field, sheds light on the life cycle of VC-backed companies. Throughout this summary, you'll learn about the Y Combinator and its impact on the VC landscape, favoring entrepreneurs. The reasons behind the author's firm's investment in Airbnb. How to get ready for your initial VC presentation. Chapter 1. Venture Capital Paradigms. Changes in the way venture capital works have occurred over the past few decades. About 50 years ago, in the early 1970s, Silicon Valley became home to numerous new businesses operating in the field of venture capital. Over the next 30 years, a small group of these companies held the majority of venture capital in Silicon Valley. This meant that a select few companies had significant influence over which entrepreneurs received funding. However, starting in the early 2000s, things began to shift. Two key factors combined to reshape the relationship between venture capital and entrepreneurs. Firstly, rapid technological advancements led to a decrease in the amount of capital needed to start a new business. On one hand, the cost of servers, networking, and data center space decreased over time. On the other hand, cloud computing emerged, eliminating the need for startups to have physical office space for data storage, which saved on rent. As a result, the reliance on venture capital for starting a business lessened compared to the past. The second factor that changed the venture capital entrepreneur dynamic was the establishment of Y Combinator, or YC, in 2005. YC is a school that teaches entrepreneurs how to create companies and secure venture capital funding. Notable graduates include the founders of Airbnb and Dropbox. YC brought together a previously scattered entrepreneurial community, allowing them to share knowledge and, in the process, level the playing field between venture capital firms and entrepreneurs. This is when the author's venture capital firm became involved. In 2009, investors Mark Andreessen and Ben Horowitz founded Andreessen Horowitz. Recognizing shifts in the Silicon Valley landscape, they understood that venture capitalists needed to offer more than just funding to entrepreneurs. While having visionary CEOs and a good product-market fit remained important, other crucial areas like recruiting, marketing, and sales might be areas where entrepreneurs lacked expertise. This is where venture capitalists like Kupor entered the picture. At Andreessen Horowitz, his role involves advising CEOs, especially by helping them establish networks and relationships with individuals and institutions. Through this approach, Andreessen Horowitz developed a successful strategy that produced several major companies, including Pinterest, Slack, and GitHub. Chapter 2. From Idea to Investor Interest. For young entrepreneurs just starting out, it's common that they don't yet have an actual product ready when they approach investors. Instead, they come with a pitch for their idea. This makes it challenging for investors to make decisions based on solid data. Instead, they have to rely on more subjective evaluations. The first part of this evaluation process revolves around the people leading the company. Who are the founders and what kind of experience do they have? The pitch they present needs to show that they can effectively turn their idea into a reality. Moreover, they need to stand out from other founders who might have similar ideas. Venture capital firms often look for a strong match between the founders and the market they are entering. This means that the founders should have a unique understanding of the product they're aiming to create due to their personal experiences. For example, consider the case of Airbnb. The founders noticed a gap in the market when local hotels got fully booked during major events. They had a clever idea to rent out their spare space to conference attendees, providing affordable accommodation. This concept convinced Andreessen Horowitz, leading them to support Airbnb. However, while the people involved are crucial, the product they're offering must address a market need. Its success usually depends on how innovative and groundbreaking it is. Small companies won't gain traction if their product is only slightly better than what's already available. It needs to bring something entirely new to the market. Apart from the people and the product, the size of the potential market is the last key consideration for venture capital firms. This is especially important because a significant portion of startups that receive big investments end up failing. To compensate for these failures, successful startups need ample room in the market to keep growing consistently. Assessing the size of the market can be tricky, especially when the market itself hasn't fully developed. In the beginning, Airbnb only saw themselves as helping a small group, conference attendees. But Andreessen Horowitz saw a bigger picture and realized that Airbnb could expand beyond that niche into the broader hotel industry and more. As history shows, this expansion strategy turned out to be a success. Chapter 3. The Art of the Pitch. If you've ever had the opportunity to present a business idea to investors who might fund it, you probably know that it can be quite nerve-wracking. Maybe you've recently left a stable job to pursue your dreams of starting a business, and whether your pitch goes well or not could determine your future success. Thankfully, the writer has heard many pitches during their 10 years at Andreessen Horowitz, and has become skilled at telling the good ones apart from the bad ones. From their experience, it's easiest to understand a good pitch by comparing it to a bad one, so let's start with the latter. Sometimes entrepreneurs will present an idea and then immediately list a bunch of companies that might want to buy them once their idea becomes successful. But even though some might think that's what investors want to hear, it's not. Investors are more interested in hearing about the entrepreneur's ambitious strategy to conquer the market, even if that strategy only has a small chance of working. The question isn't about potential buyers. What investors want to know is what the world will be like after the entrepreneurs have succeeded with their idea. Of course, after entrepreneurs present their ambitious strategy, they can expect investors to challenge it. During a pitch, potential investors will inevitably find weaknesses in the entrepreneur's strategies through a process the writer calls the idea maze. This is when entrepreneurs get asked about how they came up with their idea, why they think it would make a good product, and what kind of research and market information they considered while developing it. At the end of the day, many entrepreneurs end up creating a product that's different from what they initially pitched, which is known in the investment world as a pivot. So when investors ask questions during the idea maze phase, their goal isn't to figure out if the product will definitely succeed. Instead, they're testing the entrepreneur's thinking process and their understanding of the product and market. However, it's important to note that this kind of major change shouldn't happen during the pitch itself. If going through the idea maze causes entrepreneurs to completely change their pitch in a 60-minute meeting, that's not a positive sign. This rapid change indicates a lack of commitment to the ambitious strategy that investors want to see from entrepreneurs. That being said, it's definitely valuable for entrepreneurs to show that they're open to good advice and willing to adjust their pitches based on it. Chapter 4: Term Sheet Insights. If you're a founder who's been fortunate enough to successfully present your business idea to a venture capital (VC) firm, the next step involves navigating the potentially challenging process of discussing a term sheet. A term sheet essentially outlines all the rules, requirements, and steps that both the VC firm and your company must follow if you're going to proceed with the deal. The details in these terms can be quite complex and puzzling, especially for founders who might not be as familiar with term sheets as the VC firm they're partnering with. However, you can simplify term sheets into two main parts, which can help you understand them better and create a more level playing field of knowledge between founders and VCs. The first part delves into the intricate financial aspects of the agreement. This might cover elements like the amount of investment, preferences in case of liquidation, and who gets to control different portions of the company's ownership. While the financial side is crucial for the short and medium term, it's the second aspect, governance, that holds more significant implications in the long run. Governance pertains to how the company's board of directors operates and who gets the opportunity to be part of the board. In term sheet negotiations, deciding who holds a position on the board is extremely significant because the board influences how the company operates, who leads it, and whether it continues as is or gets sold. Furthermore, the board is responsible for selecting the company's CEO, a decision that holds immense importance. Typically, the author suggests that a term sheet from their company outlines a 3-person board of directors. One of these positions is filled by a representative from the VC firm, another by the company's CEO, usually the founder, and the third by an independent outsider who has no vested interest in either of the other two board members. As your company grows, so does the size of the board. Therefore, in your initial term sheet, it's crucial to ensure that the board remains well balanced. For instance, if your company secures additional funding from a different VC firm in another financing round, they might also seek a seat on the board. In such cases, it's important to negotiate that for each new VC representative on the board, there will also be a corresponding representative from your own company. Chapter 5: Managing Board Dynamics. With a favorable term sheet secured, the CEO can now focus on managing her newly funded company. Besides overseeing the daily operations of the company and guiding her team, the CEO, especially if she's also the founder, must also keep her long-term vision in mind. However, the CEO's relationship with the board of directors can sometimes complicate matters. Therefore, it's crucial for both sides to maintain a positive and cooperative relationship. This is especially important regarding the connection between the CEO and the venture capital (VC) representatives on the board. While most effective boards give CEOs the freedom to lead their companies, this isn't always the case. In many situations, VCs were once CEOs themselves and might be tempted to get involved in the day-to-day affairs of the companies they've invested in. Nevertheless, VCs shouldn't be overly involved in the minute operational details of a company. That's the CEO's responsibility. Hence, it's crucial for VCs to keep an appropriate distance and allow CEOs to execute their strategies. However, it's still important for the CEO to maintain a constructive and open line of communication with VCs and other board members. VCs often have experience serving on various boards and can offer valuable insights based on the mistakes they've observed other CEOs make. This is particularly beneficial for first-time CEOs who might excel in vision and team management but could make novice errors in areas like hiring or long-term planning. While VCs can provide guidance, it's essential to ensure they don't become overly controlling. Even though VC firms provide the funding, it remains the CEO's responsibility to lead the entire operation, including the board. From the beginning, the CEO should communicate the desired feedback channels with the board. This could involve regular meetings where advice is exchanged and company updates are shared. In cases where there are multiple VCs involved, the CEO might not have the time to meet individually with each one. In such instances, it's often more efficient for the VCs to collaborate and consolidate their feedback to present it to the CEO in a more concise manner. Chapter 6. Looking beyond venture capital. Imagine, just for a moment, that your company isn't facing financial ruin and closure after receiving multiple rounds of funding from venture capitalists that ultimately led nowhere. If this scenario applies to your company, then congratulations are in order. You belong to the 10% of startups that manage to avoid failure. Assuming you're now the CEO of a profitable business capable of standing on its own without relying on venture capital, you're likely receiving offers for potential buyouts. In fact, about 80% of successful startups backed by venture capital end up being acquired by larger companies. However, there are several important matters that CEOs and boards should think about when considering any potential acquisition deal. One of the most significant concerns revolves around determining which employees will continue working for the company after the acquisition. It's possible that many key employees have remained loyal to you as the CEO for an extended period, and now it's time to recognize and reward their dedicated efforts. This also involves negotiating favorable equity agreements for the team members you bring along with you into the company's new post-acquisition phase. Apart from acquisition, another option for boards is to pursue an initial public offering, or IPO. This involves making the company's shares available to the public and trading them on the stock exchange. Setting the right price for these shares is a crucial challenge. For instance, when Facebook went public in 2012, it initially set the share price at $38. However, within the first day, it dropped to $14. Fortunately, by mid-2019, the share value had increased more than fourfold. Still, overly high initial share prices can lead to negative perceptions haunting your newly public company in the future. Therefore, it's advisable to seek guidance from a competent team of investment bankers to determine the appropriate initial share price. Of course, whether a company gets acquired or goes public, the matter of compensation for venture capital firms takes center stage from their perspective. At this juncture in the company's history, the venture capital lifecycle is nearing its conclusion. The initial funding of the company is on the verge of paying off, and venture capitalists are preparing to reap the rewards for the risk they initially undertook years ago. However, if venture capitalists sell off their shares too rapidly, it could lead to a significant decrease in the company's value due to a perceived mass sell-off. Therefore, it's often a prudent strategy for venture capitalists to gradually divest their stock over time instead of all at once. Lastly, as the CEO, your next phase of the journey is about to commence. Whether you've recently gone through an IPO or an acquisition, the original concept that you presented to venture capitalists is entering a new chapter. You now find yourself accountable either to the CEO of a larger corporation or to public shareholders. Regardless of the outcome, take pride in the fact that you've joined the select group of startups that have successfully moved beyond the venture capital stage. Conclusion. During the early 2000s, as numerous new technology startups emerged, the dynamic between venture capitalists, VCs, and entrepreneurs went through significant changes. In today's landscape, one of the primary qualities that VCs seek in companies is a founder who possesses a distinctive understanding of the issue their product aims to solve. A critical aspect of gaining VC's support for your product involves perfecting the skill of presenting, which includes demonstrating a readiness to adjust your approach while remaining fully dedicated to the value of your concept. Once you secure funding from VCs, the subsequent challenge involves nurturing positive connections with them, where a well-structured term sheet can be beneficial. And if you successfully progress to an IPO or acquisition, you'll have become part of the exclusive group of founders who achieved this accomplishment.